You have to look at what parts of the market are expensive and what parts are cheap. And unfortunately, right now, a lot of people are very nervous. And so the stocks that are cheap are those that are a little bit economically sensitive. Things like the banks, the financials, some of the bigger industrials are trading at attractive prices, but you have to be willing to take some of the short-term volatility that comes with those names.
Okay, and what are some of those names that you like? What are you scooping up? And when you talk about short-term volatility, are these holdings that you would keep on for the long term?
Yes, these are very high-quality companies that have a great long-term outlook, but they are names that are tied to the market. So something like KKR is an extremely high-quality private equity firm that's growing, that's in the private equity and alternative asset space. And yet it's trading barely above book value. The stock is trading around $12 a share. You basically get the book value, and then you get the 2 and 20 fee structure, the 2% management fee plus 20% of the profits for free. So it's a wonderful long-term investment. You get to be Henry Kravis's partner, but on days when the stock market goes down, its stock goes down.
Okay, so some specific names there. So those are cheap. Financials have been the worst performing sector so far year to date. But what about the expensive stocks? Do you want some of them in your portfolio to diversify some of the safety stocks like utilities?
Yeah, we would argue that a lot of the stocks that are trading like bonds, bond substitutes, stocks with higher yields, are way too expensive. They are being priced off of the lowest treasury yield in 200 years. And we think those are stocks where you can be hurt badly once we get a return to a normal interest rate environment. So some of these utilities, these REITs, these MLPs are, we think, very dangerous because they are a bond substitute right now, and those are just overpriced.
Okay. What does this all mean for the Fed? Because they've got the July meeting coming up and then the September meeting. We also have the jobs numbers coming up on Friday. I mean, theoretically, if the jobs numbers are good and unemployment hits, stays at around 4.6, 4.8%, what kind of position does this put the Fed in? Because their mandate is inflation and jobs, yet can they lean on this whole global uncertainty as an excuse not to move the next couple of meetings?
The conventional wisdom is that we aren't going to get an increase in interest rates. The markets are betting on no increase in interest rates, which is why the utility stocks are so expensive and why the financials are so cheap. We think that that's not a foregone conclusion. We think if we get even a hint of inflation, there'll be pressure on the Fed to put interest rates higher. And we think there are some subtle pressures on inflation. Higher cost of living, higher medical costs, higher rental costs, higher labor costs, tightening labor markets. We think all those things could start to put the pressure on the Fed to increase rates, and that would paint some of those utility stocks into a very tough corner.